I think, just to set the record straight, I know it's close to impossible to try to time the market, but we cannot deny the fact that a relatively good timing, I don't mean by catching the bottom of course, but just buying at a relatively low level does significantly improve the return profile of your investments. That said, I think most of us shouldn't spend too much time trying to quote unquote time the market, but instead focus your energy and efforts in trying to find value in today's market. So I wanted to kickstart this video with this backdrop because of my encounter with Alibaba thus far. Yes, I've been with this stock for close to 2 years now. I've taken away many lessons along the way, and I'll probably synthesize whatever I've learned in a separate video. So for investors that said that they've went through the 2020 or 2022 bear market, I tend to just smile and be happy for them. So I think the Chinese tech crash was in a league of its own, but who am I to comment? I'm just a fellow retail bag holder. So the only thing I need is actually just the like button, in case you've forgotten to click on it. Now, don't get me wrong, I'm extremely elated for those of you who have joined me much later in this game, with averages on Alibaba between $70 to even $90. You guys are the walking legends, even better than Charlie Munger himself. Congrats! But I think a majority of you who actually stuck around for a long time will have averages closer to me, in the 120s, 150s, and some even the 180s. Despite this recent rally, however, many of us are still underwater by a large extent, and there's clearly nothing to be happy about. So a small part of me do feel slightly regretful, probably asking myself along the lines of, why did I buy so aggressively so early on? What was I trying to chase? When Baba was at 60, I only had limited dry powder left to continue averaging down. In fact, just to be transparent, I did leverage up by just a little bit after that gap down because I was waiting for my paycheck to come in. So for long-time viewers, you guys should already know me that I'm extremely against using any sort of margins or even going on with leverage. So I even turned into someone that I couldn't recognize myself. But don't worry, I wasn't like 1.5 times leverage or something. I just took out additional money to buy that dip because I know I'm going to get that X dollar amount that I took out in 2 weeks time. So I just needed to advance that sum of money from the broker for a short while. So I've repaid it since. Long story short, I think there were many valuable lessons to be learned, and I don't think it's all sunshine and rainbows from here on. A 55% move from Alibaba in 5 weeks sounds pretty crazy, and I think it is. So even though I've tried to call for the bottom on just Monday alone, I'm prepared for the worst, so we shall see. Thankfully, I didn't shy away from giving you guys an update at the end of October, and that was around the time where many of these Chinese stocks were trading at 52 weeks low. So if you want to fact check me, feel free to watch my older video with the title, How Many More Alibaba Did This Crazy Buy? And I released that video right after the party congress, which was essentially my last bullet that I shot. So to save you the trouble, I've screen grabbed my portfolio position from that video. Contrary to popular belief, because I believe many of you on this platform are probably skeptical that YouTubers are out here to scam you and can only show you the positions that are in the greens. Personally, as a viewer, I'm also particularly wary of people on this platform that claims that they have incredible performance regardless of how the market moves. And they happen to always front run the market, and I don't know how. And if they fail to front run the market, they're just going to say that they only have a small exposure. Anyhow, in the last update, every single one of my positions are in the red. Every single one of them. And my largest one, Alibaba, was down 24,000. And this was after averaging down on that fateful Monday after the party congress. So the simple returns on that portfolio by dividing my base capital to the portfolio value came out to be around negative 40% give or take. So I'm sure if you want to do a time-weighted return, it will be significantly worse. So at its lowest, I think I was down more than $35,000 overall. Was I affected? I would be lying if I said I wasn't. The funny thing is, you would have thought that being in this position for the last 2 years, because I've been in this Chinese tech saga for 2 years now, it might have numbed the feelings involved. But clearly, it doesn't. Because the absolute dollar amount that I lose just keeps increasing by the day. Now, this is the return profile of the portfolio in the past month generated by Tiger Brokers. So I don't have all my positions stated in this Excel in just one brokerage platform, in case they pull an FTX on me. But yes, most of my stocks are currently held in Tiger, and the rest of them are on Weibo, Moomoo, Interactive Brokers, Syfe, and FSM1. So don't ask me why I have so many accounts. I don't have so much money for now, but I'm slowly working on it. Which brings me to the sponsor of today's video. Weibo just extended their latest sign-up reward, and it has never been better. So you can get up to $150 cash voucher if you fund and trade your Weibo account today. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade for a stock or ETF and one option. And that's a whooping 10.5% ROI on your initial capital. So for those of you who have been sitting on the sidelines for some time now, I think this is the sign to get yourself motivated. So Weibo prides itself on zero commission trading. So let's stop paying commissions and use them to buy more Alibaba. So if you need another reason to sign up for Weibo today, they are also giving out attractive referral rewards if you get your friends to sign up using your own referral code. But of course, you should do so with mine first. Wink wink. Don't let this 10.5% ROI slip away so easily. Link will be in the description. Thank you Weibo for sponsoring this video. So the beta of my portfolio, or some of you might call it volatility, is pretty intense. Definitely not for the weak-hearted. So having went through this myself, I would not recommend it to anyone. But you should probably use me as your classic case study. So I'm presenting to you both the good and bad side of concentrating a portfolio. So in case you haven't realized already, 80% of the positions are highly correlated. Alibaba, Tencent, and KWeb. So for viewers with sharp eyes, you probably realize that I've added a new position. So I've actually took interest in the basket of Chinese banks for quite some time now. And I believe for people who have stuck around for long enough, you should kind of have a gist and have some sort of understanding of my investment style. You know that I love investing in places where people are essentially running away. The more people are afraid of a particular sector or a particular company, the more I love to understand and analyze if there is an investment opportunity. So I've made the conclusion that I think Chinese banks at current valuations provide a relatively good risk to reward ratio, which was why I started a position in them. So I've lumped everything together under the same header, and I might make a separate video essentially trying to explain my thought process if there's enough interest in the comments. So do feel free to leave in the comment section down below if you're interested in Chinese banks as well. If not, I'll just keep it to myself and we'll see how this whole China property apocalypse is going to play out and whether I can profit from this. In case you haven't realized already, there is a ton of fear-mongering videos on this YouTube platform. So on a portfolio level, I've actually never added to any individual position since, but still continue averaging into KWeb and VT. So even if I were to remove the additional capital injection towards Chinese banks, the simple returns swung from negative 40% to negative 16% with the exact same positions. And this is just the nature of a concentrated portfolio. Just take it as a precaution. So I'm not here trying to advocate for the quote-unquote right investing methodology, because personally, I believe that there is no right way to invest, but only one that suits you, so you should really know yourself. So I'll end off this video with two specific quotes that seemingly contradict each other, but are both said by investing legends themselves. The first one by Warren Buffett. Diversification is a protection against ignorance. While Charlie Munger, on the other hand, also argued that you should remember that good ideas are rare. When the odds are greatly in your favor, bet heavily. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye.